Most investors can see what a company has already accomplished: its sales, its earnings, its assets, its past. But the greatest investments are not always found by looking backward. In the 1950s, Motorola was already a successful electronics company. It made radios, televisions, communications equipment. But beneath the company everyone could see, something else was beginning to take shape. New technologies, new markets, new possibilities whose payoff still belonged to the future. Most of that future could not yet be found in the numbers. Philip Fisher was looking anyway, and he believed there was a way to see what the financial statements could not. The question is, how did Philip Fisher recognize what Motorola could become before the numbers could prove it? Philip Fisher approached investing differently. He wasn't satisfied with knowing how much a company had earned last year, what its assets were worth, or whether its stock appeared cheap. He wanted to know something harder. Could this company keep growing? Could it develop new products? Could its management recognize opportunities that didn't yet exist? And could the business remain exceptional long enough for those advantages to matter? These were questions that couldn't always be answered by studying a balance sheet. Fisher believed that the greatest investment opportunities could come from companies whose real potential had not yet appeared fully in their financial results. That meant understanding more than the stock. He needed to understand the business, its management, its competitors, its customers, its technology, and the people who understood the industry from the inside. For Fisher, investing was becoming something closer to an investigation. The financial statements were still evidence. They simply weren't all of the evidence, which left Fisher with a problem. If some of the most important information about a company couldn't be found in its financial statements, where was he going to find it? Fisher called his approach scuttlebutt. The idea was simple. If you wanted to understand a company, don't rely only on what the company said about itself. Look around it. Talk to the people who knew the industry. Customers could reveal how well a company's products actually performed. Suppliers could provide another view of the business. Competitors could tell you which companies they respected and which ones they didn't. No single conversation provided the answer. The power came from comparing what different sources were saying. Patterns began to emerge: strengths, weaknesses, reputations, and sometimes evidence that the business might be capable of more than outsiders realized. Fisher wasn't looking for rumors. He was looking for clues that could be tested against one another. And in the 1950s, one company offered an especially interesting collection of them. Motorola was already successful. But beneath the business investors could see, something was beginning to change. What was happening inside Motorola? By the middle of the 1950s, Motorola was already a successful company. Its name was familiar to millions of Americans. Radios had helped build the business. Televisions had expanded its place inside American homes. And communications equipment had created another important market. But Motorola wasn't standing still. Behind those established businesses, the company was investing in technologies that could take it somewhere new. One of them was the transistor. In 1955, Motorola introduced its first mass-produced semiconductor, a high-power transistor developed for automobile radios. It was an important step. The company was no longer simply building electronic products. It was developing some of the components that would power the next generation of them. Motorola was also expanding its communications business and investing heavily in research and development. Then, in 1956, Robert Galvin became president. A new generation of leadership was taking control, just as the electronics industry itself was beginning to change. None of this guaranteed what Motorola would become. Semiconductors were still an emerging business. New technologies required enormous investment, and the financial rewards could take years to appear. But the clues were beginning to point in the same direction. Motorola wasn't depending on a single successful product. It was building the ability to create what came next, which raised a different question. Was Fisher investing in Motorola's products, or in the company capable of creating them? For Fisher, the answer went deeper than any single Motorola product. He was searching for companies with the ability to keep creating opportunities long after today's products had run their course. His framework eventually became famous for 15 questions, but several of them pointed toward the same idea. Did the company have products capable of producing years of future growth? Was management determined to keep developing new ones? Was its research and development actually productive? Did the organization have the leadership to turn opportunity into results? Motorola gave Fisher reasons to keep looking. The company was expanding beyond the businesses that had already made it successful. It was developing new technologies, building semiconductor capabilities, expanding communications, and preparing for markets whose ultimate size was still unknown. Fisher did not need to know exactly which Motorola products would dominate years later. That wasn't the bet. The more important question was whether Motorola possessed the organization, management, and technical ability to keep finding its next opportunity. Fisher wasn't trying to predict the company's future. He was trying to determine whether Motorola had the ability to create one. He had found the qualities he was searching for. But there was still one question no amount of investigation could answer in advance. What would happen next? The answer did not arrive all at once. It arrived over decades. Motorola continued pushing into technologies that had barely begun to emerge when Fisher first studied the company. Semiconductors grew into a major business. Its communications technology expanded. Motorola equipment helped carry communications into space. And in 1973, a Motorola engineer demonstrated the first handheld cellular phone. 10 years later, the company introduced the first commercial handheld cellular phone in the United States. By then, Motorola looked very different from the company known primarily for radios and televisions decades earlier. The individual products had changed. The underlying pattern had not. Research led to new technologies. New technologies opened new markets. And new markets created opportunities that could not have been measured when they were still only possibilities. Fisher's interest in Motorola was already documented in the 1950s. Motorola appeared among the companies discussed in his original 1958 Common Stocks and Uncommon Profits. And over the years that followed, it became one of the investments most closely associated with his career. Eventually, the future supplied evidence that hadn't existed when Fisher first began looking. Which brings us back to where this case began. The numbers can tell us what a company has already accomplished. But if the numbers can only show you what a company has already become, how do you recognize what it could become next?